Mining stocks, especially gold and silver miners, have already ripped higher lately. Yeah, some of them 2 or 3 times up, depending on what you're watching. And here's the part that makes people blink. Even after that run, the sector is still sitting near what looks like historic lows relative to the broader market and relative to the metals themselves. That's the weird paradox we're in right now. Prices moved, but positioning didn't. Attention didn't. Ownership didn't. Most portfolios still don't have a single miner in them. And that gap between what's happening under the hood and what the crowd is actually paying attention to is where the real, explosive setups tend to form. OG John AG here. Ninja exposed dropping real soon. Stay tuned. And if these breakdowns are actually helping you, do the quick thing. Drop OG John AG in the comments so I know you're one of the real ones. Also, the WhatsApp link was bugging out for some people. It's sorted now. Link in the description. We keep it tight. Scammers and bots get blocked. Real ones only. Because the moment you start talking about miners, the weird accounts swarm like moths to a screen. Now listen carefully, because this part is what kicked me into making this at an hour where normal people are sleeping. Yesterday, January 23rd, Doug Casey dropped an interview, and if you're anywhere near commodities, you should have seen it popping up everywhere by now. The guy has been around mining for decades, half a century of scars, 5 major bull markets he's lived through, and more cycles than most people have had jobs. And he said, on record, something that made my eyes narrow in that wait. What did he just say? His words were basically, mining stocks are the most explosive opportunity of his lifetime. Not interesting, not undervalued, explosive, lifetime. People love to call anything a once-in-a-generation moment. Most of it is noise. But when someone who's watched every major metals mania since the 1970s says we're looking at a generational setup, you at least lean in. Because experience isn't magic, but it does mean they've seen what real tops feel like, what real bottoms look like, what fakeouts smell like, and what the early innings of a monster move actually sound like before the stadium fills. Here's the core setup he's hammering, and it's simple enough that even people who hate markets can understand it. Imagine gold trading near $5,000 an ounce. Imagine producers pulling it out of the ground at roughly $1,500 all-in sustaining cost. Do that math and don't rush it, because most people's brains refuse to accept it the first time. That's not a cute margin. That's a canyon. That's the kind of spread that makes balance sheets mutate. That's the kind of spread where one quarterly report can re-rate an entire company if the market actually decides to look. And Casey's bigger point isn't gold is high. His point is what happens when margins explode while the equity market still treats miners like it's 2015. When gold was $1,200 and costs were $1,100, miners were basically treading water. They weren't building empires. They were surviving. A $50 or $100 margin doesn't change the world. It doesn't build cash piles. It doesn't erase debt. It doesn't create buybacks. But when margins turn into thousands per ounce, the business becomes something else entirely. Suddenly, a producer that looked mediocre on paper turns into a cash machine. And the market, eventually, has to reconcile that. Not because it's kind, because it's arithmetic. Then he drops an image that's so visual you can't unsee it. When the market decides it wants into gold and silver stocks, it's like trying to force the contents of the Hoover Dam through a garden hose. Let that sit in your head for a second. Hoover Dam, millions of tons of concrete, enough water to drown your sense of scale. Garden hose, tiny pipe, limited flow. That's liquidity mismatch. That's what happens when a sector is small, underowned, ignored for years, and then suddenly becomes the it trade. Prices don't politely walk up. They gap. They spike. They go vertical because there isn't enough supply of shares for the demand trying to squeeze through. And that's why he's pushing miners, not just the metal, because miners are leverage. Not options leverage, business leverage. If gold goes up 10%, a miner's profit margin might go up 30%, 50%, 100% depending on their cost structure. The metal moves like a weight. The equities move like a spring. Casey references something that veteran commodity people whisper like a campfire story. In real bull markets, the crappy little stocks go 10-1 as a group, and some go 100-1. Not because they deserve it on fundamentals alone, because flows overwhelm a tiny pond, because attention turns into a stampede, because the public arrives late, excited, and loud, And they don't care about valuation the way they pretend they do in calm markets. They care about making up for missing the first move, and they buy whatever is moving. Now, before anyone screams, "Pump," here's what made this interview hit different. He didn't just talk. He posted actual names he owns. No affiliate nonsense. No paid placement vibe. Just a transparent, here's what I'm in list. Silver tilted names, gold plays, some broader commodity exposure. Copper, platinum group metals, lithium, uranium, rare earths, even graphite. The point isn't that you should copy-paste a stranger's portfolio. The point is conviction plus transparency. When someone's willing to say, "These are my positions," it's harder to dismiss them as just talking for attention. And the way he's positioned tells you what he believes is coming. Not a neat, polite move in one metal, but a broader multi-year commodity cycle with the biggest torque in small-cap miners. A basket approach. Some stability, some torque, some lottery ticket upside. A spread across the complex, but with heavy emphasis where liquidity is thinnest and upside can become ridiculous fast. So what is he seeing that most investors are missing? First, the margin environment I mentioned. This is the backbone. When margins go from thin to absurd, the entire perception of a company changes. A junior producer doing a few 100,000 ounces a year doesn't go from meh to nice. It goes from meh to why is this market cap still priced like it's broke? Because if the math holds, the cash flow can become enormous compared to what the stock is priced for. That's how re-ratings happen, not gradually, suddenly. Second, and this is the one that people outside the commodity world really don't get, silver supply is weird. Most silver isn't mined because someone wanted silver. It's mined because someone wanted copper, lead, or zinc, and silver came along for the ride. That means you can't just turn on silver supply when the price spikes. If 70 to 80% of silver is byproduct, then higher silver prices don't automatically translate into a wave of new pure silver production. You can't manufacture or bodies. You can't snap your fingers and build a new primary silver mine with a clean timeline. Geology doesn't care about your chart. Permitting doesn't care about your hype. And financing definitely doesn't care about your excitement. So when demand rises, solar panels, EVs, electronics, data centers, military tech, next-gen infrastructure, supply doesn't respond the way people assume it should. The result can be violent. That's why Casey is so focused on the few true silver miners that exist. If money floods into that narrow lane, there simply aren't enough big, liquid names to absorb it smoothly. The garden hose problem again. Flow meets thin float. Thin float meets panic buying. Panic buying meets vertical charts. Third, his read on cycle timing. This is where the veterans separate themselves from the people who just discovered commodities on social media. He's lived through late 70s mania energy. He's watched the 2000 to 2011 supercycle. He's seen juniors explode in waves. Early, mid, late. Each wave pulling in a bigger crowd. And his claim right now is we're early. Not the first day, but early enough that the public hasn't piled in and institutional ownership in the small caps still looks thin. The big crowd hasn't arrived. The taxi drivers aren't talking about drill results. Your cousin who only buys tech stocks isn't sending you silver memes yet. That's what early feels like. And you can see hints of the tremors. Precious metals chatter creeping back up. Communities online building momentum. ETF flows shifting after long stretches of apathy. Central banks still treating gold like insurance. Physical markets showing premiums that don't always match the paper price action. These aren't guarantees. They're tells, like the first distant rumble before the storm gets loud. Technically, miners have also started doing that coiled spring thing they do before they really move. Big miner ETFs broke key resistance levels, then started consolidating instead of collapsing. A healthy consolidation after a breakout isn't weakness, it's a pressure build. Volume dries up because sellers are exhausted, and buyers are waiting for the next catalyst. Juniors often compress even tighter, triangles, handles, boring sideways action that makes people lose interest right before the next leg. And silver miners? They're infamous for frustrating everyone until they don't. They base, they fake out, they grind, and then one day they rip 15% in a session and never look back. If you've watched this space long enough, you know the pattern. Boredom, 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 then chaos. Now let's talk about the part nobody wants to say out loud when they're trying to keep things viral. This sector is not for the emotionally fragile. The upside can be insane, but the path is not smooth. Miners can drop 30 to 50% and still be in an uptrend. Juniors can get smoked on dilution, bad assays, financing risk, permitting delays, political headlines, a CEO misstep, or just because the market decided today is risk-off. You don't buy these expecting them to behave like an index fund. You buy them knowing volatility is the price of admission. There are real risks that can push this thesis out longer than anyone expects. Macro matters. If rates stay higher longer, risk assets can choke even if metals hold up. We've seen periods where gold is fine, but miners still get punished because the market is discounting future cash flows at a higher rate. Geopolitics is double-edged. Yes, fragmentation and currency distrust can support metals, but a miner in the wrong jurisdiction can get wrecked by policy shifts, taxes, or nationalization risk. Execution risk is real. Great rocks don't automatically become great businesses. Management can ruin a good deposit with cost blowouts, weak financing, or endless delays. And timing risk is brutal. You can be right on the big picture and still suffer if you're over-levered or impatient. Then there's the paper market reality. Derivatives influence short-term price discovery. Big players can defend levels, shake out weak hands, and create ugly head fakes that make you question your sanity. None of this requires conspiracy brain. It requires understanding how large futures markets behave and how thin equity sectors react when metal prices get whipped around. So if someone is listening to this thinking, cool, I'll just throw my rent money into penny stock miners and become a legend. No, that's how people become cautionary tales. If you can't stomach drawdowns, if you can't wait, if you can't manage position size, miners will humble you fast. But here's why the thesis still has teeth if you approach it like an adult. Supply and demand dynamics in silver aren't just vibes. They're measurable. When deficits persist, above-ground inventories don't magically refill. Recycling helps, but it's not a faucet that can suddenly replace a structural gap. Industrial demand isn't a one-time fad either. Once infrastructure builds out around a metal, it tends to stay embedded. The world is getting more electrified, more connected, more power-hungry, more hardware-dependent. Silver is not just jewelry and coins anymore. It's a functional input in systems that don't work without it. And on the gold side, if prices remain elevated while costs stay relatively contained, the free cash flow math becomes too obvious to ignore. Markets can ignore obvious things for a while. They can't ignore them forever. Eventually, someone screens for cash flow yields, sees miners throwing off piles of money, and the narrative flips from miners are value traps to miners are printing. When that flip happens, multiples expand. That's when the Hoover Dam starts pressing against the hose. Jurisdiction risk can be managed by being picky. You don't need the spiciest project in the sketchiest place to get leverage. There are plenty of undervalued names operating in safer regions. And timing risk can be managed with strategy instead of adrenaline. Build a basket, scale in, don't chase green candles, don't bet everything on one drill result, and don't pretend you can predict the exact week the crowd shows up. If you want to think like Casey is thinking, without copying him, here's the mindset. You want to mix. Some producers for stability and cash flow. Some developers with near-term catalysts like permits, feasibility studies, or construction decisions. Some explorers if you can handle lottery odds and dilution risk. You want management teams with skin in the game, not just salaries. You want clean share structures when possible. You want a reason for the market to care within the next 6 to 12 months, because catalysts are what turn cheap into re-rated. And you want to be honest about the hold period. The big multipliers rarely happen overnight. They happen in phases: bottoming, basing, breaking out, consolidating, and then the late-stage frenzy when the public piles in and buys everything that moves. And that's the heart of Casey's point. He's not talking like someone calling a top. He's talking like someone who thinks we're still climbing onto the runway. He's waiting for the moment the story becomes mainstream and the flows become unstoppable. When that happens, the little stocks don't drift up. They get dragged upward by a tide that doesn't care about your limit order. So where does that leave you right now, in late January 2026, with a veteran on record calling this the most explosive opportunity of his career? It leaves you with a choice. not a choice between rich and poor. A choice between acting like this is just another social media clip or acting like cycles exist and setups can be rare. You either decide the commodity cycle thesis makes sense and position with discipline, or you don't and you watch from the sidelines. The middle ground, half believing but never acting, usually leads to the worst outcome. You buy late, emotionally, after the biggest move because you couldn't handle being early. Do your own due diligence on anything you buy. Read reports. Understand the jurisdiction. Learn the management team's track record. Watch insider ownership. Look at financing needs and the share structure. Ask yourself what the next catalyst is and what can go wrong. Don't buy a story because it sounds cool. Buy a business with a path to value creation that the market hasn't priced yet. And don't confuse volatile with broken. In mining, volatility is normal. It's the entrance fee for asymmetric upside. And since people always want the summary in plain language, here's the simple version without pretending it's a magic spell. 1. Margins for gold producers can be historically attractive when metal prices run ahead of costs, and that can force equity revaluations when the market finally pays attention. 2. Silver is uniquely positioned because much of its supply is byproduct, which can create extreme supply tightness when demand rises, and that tightness can hit silver miners like a lightning bolt. 3. The sector is small and underowned enough that if the public and institutions rotate in together, the liquidity mismatch can turn moves into melt-ups. The unresolved tension is timing. Early can mean soon, or it can mean longer than people want. That's why leverage is dangerous here. That's why position sizing matters more than your confidence. The difference between being early and being wrong is whether you can stay in the game long enough for the thesis to play out. So don't invest money you can't afford to lose. Don't use leverage you can't control. Don't follow anyone blindly. Me, Doug Casey, or the loudest account on your feed. Use logic, not hype. But also understand this. Moments where long cycle veterans go on record with statements like that don't happen often, and they don't last forever. If the dam really does hit the hose, you won't get a polite invitation. You'll get a chart that looks fake in a comment section full of people pretending they were there the whole time. OG out and about.